listening to It's Not Too Late, Understanding Dairy Revenue Protection and Using It to Your Advantage. DRP for New Hampshire dairy producers. My name is Devin Smolak. I am a crop insurance agent for the state of New Hampshire. I work out of Bedford, New Hampshire, and I will begin this presentation with a bit of the educational portion of the dairy revenue protection and how it works. Then I will be passing it along to Tristan Peterson, our livestock risk management specialist, and then Farm Credit East, Ethan Robertson. Okay, so we have a disclaimer as well. Although we've made every attempt possible to ensure that the information is accurate, please refer to the specific crop provisions, special provisions, or basic provisions. And we also encourage you to consult with our agents for guidance concerning your specific situation. Since there's so many moving parts to this program, one size does not fit all. Okay, before we begin getting into the details of the Dairy Revenue Protection Program, many of you may be concerned that you've already enrolled in a milk program this year, and maybe you're confused, or maybe you're not sure if you can enroll the same milk at the same for the same time. Well, the dairy margin coverage would be something that you signed up with at FSA, and you'd be protecting the margin between feed costs and the milk price. So this is a different program than the program we're discussing today, but you are able to enroll the same milk for the same time as if you've already enrolled in the dairy margin coverage. A big difference too is that DRP does not have a limit on how much milk you can enroll up to what you can enroll. But you can cover the same milk at the same time. However, if you're familiar with the livestock gross margin coverage, it's also sold by a licensed agent, and it's similar to the DMC. It has a little bit of differences. That's actually not allowed for the same month as an enrollment in DRP. So before you make a decision based on whether to go with DRP or LGM for a set number of months, it's important to talk with your agent and see which one works better for you at that time. Okay, so what is DRP? Dairy Revenue Protection provides protection against a decline in the quarterly revenue from milk sales of Class 3 and Class 4 futures. It is a quarterly coverage endorsement, so it can be sold up to 5 quarters in the future. The furthest quarter currently that we can enroll in is quarter 3 of 2022, July through September. In the nearest quarter we can enroll in is quarter 3 of 2021. You may enroll in as many quarters as you wish, and you don't have to enroll them all at once. We have 2 pricing options available to us, both based off Class 3 and Class 4 milk prices, futures. The first option is Class Price, which separates Class 3 and Class 4 milk prices. You can do a blend as well. And then the second option is the component options, which takes that Class 3 and Class 4 futures, but it kind of it shows up as butterfat protein milk solids. So you can use your own component values to capture your milk's actual value using the component pricing option. However, unlike the class pricing option, the component pricing, you have to combine all those components together in one endorsement. So just 2 different strategies for a similar program. The farmer also gets to choose how much milk to cover during the quarter. So if you're familiar with other crop insurance programs, you may know that you need to report all of your crop. This program is different. So you can enroll as much milk or as little as you need or you wish, and you don't have to enroll it all at once, up until what you produce. Another feature of this program is that you can enroll, you can cover from 80 to 95% of the milk price for that daily sale in 5% increments. Typically, I see that 95%, but depending on your operation, some people do go with the 80% if they have a lower cost of production. But typically, we see that 95%, and I'll go into more depth with this more in the presentation. And then finally, To make this an insurance program, we needed some sort of something to make it actuarially sound. So we do index the milk production. So we're part of the northeastern region, just like New York and Vermont. However, we are a grouped pool. We aren't state indexed. So in New Hampshire, we have the same. We're in the same group as Maine, Mass, and Connecticut, and a couple other states. Whereas Vermont and New York would have their own state agricultural data to back up their expected production, which we'll get into in the next couple of slides. Okay, so if you're familiar with the revenue protection insurance for corn and soybeans and wheat, DRP is similar to this, in which if there's more volatility in the market, there's going to be a higher premium rate for that quarter. And it's assuming that the risk further out into the future is riskier than the risk closer to the nearby quarter. So you're going to see higher premiums during higher points of volatility, meaning that there's more value to capture, and so the premium is going to adjust to that. Here we have the Drp Premium Support. So as I mentioned before, it's a subsidized program, and this is just showing the different subsidies for each coverage level. Again, you need to be conservation compliant. You fill out an 80-1026 at FSA, and they can help you with that. Now, this program can be intimidating if it's the first time you've heard about DRP, but it really narrows down to 5 main producer decisions. The first and most important being the value of your milk to protect. So what daily sales price do you want to lock in? What floor do you want to set for your operation using this program? And again, we have from 5:30 Eastern Standard Time to 10 a.m. Eastern Standard Time the next day to capture or set that floor for that daily sales price. Secondly, we have to decide how much milk we want to cover. We're not required to insure all milk production. You can do as little or as much up to what you produce as you'd like. And you don't have to enroll it all in the same day either. You can stagger it. You can put a little bit in at a time, or you can put the whole thing in one day if you just want to walk away and your floor is set. But it's definitely not required to insure all of your milk production. Thirdly, you get to select the level of coverage you'd like. Again, we'll go through an example. We'll show you the difference between 80 and 95% of the revenue guarantee, and you can make your own determination on what coverage level fits your risk management plan better. The fourth decision would be when. So what quarters do you see the most risk in the market where you're not sure if your milk check is going to meet your budget, if you think the price is going to decline in certain months, like the spring flush, or other parts of the year where your milk check's been a little low. So that's the fourth. And then finally, the fifth decision you have to make, which we're not going to get into too much detail on this webinar. It's something you definitely want to discuss with your crop insurance agent because there are many things you can do. But typically the protection factor, I use that if a producer is concerned that they're not going to be able to capture the full value of their milk because they can't produce enough of what they're claiming. So it's a multiplier we can use to capture that full value while not enrolling all of our milk. Okay, and since we're working with animals here, there is a little leniency in the program. Our records will be our milk checks, but the producer must deliver 85% of the declared cover milk, or else the loss is reduced. The loss, not the premium. So that means if you enroll 10,000 hundredweight, you're going to need to provide at least 8,500 hundredweight on your milk checks. Otherwise, you're going to have a reduced indemnity and still pay full premium. If you decide to go with the component option, you have to at least have 90% of the component values you declared. So if you're at 4% butterfat, you need to provide at least 3.6%. Otherwise, the policy is recalculated based on the actual components, but the premium is not. Okay, so here's an example of class pricing, and I'm just going to walk through it with you. So we're in New Hampshire, and our county is Merrimack. Unlike other crop insurance policies, the counties don't really make a difference in terms of pricing and things because we're in that grouped pool I mentioned earlier. The day we decided to lock in was April 16th, again, between that 5:30 Eastern Standard Time and that 10 o'clock Eastern Standard Time. The quarter we enrolled in was Q1, 2022. Our protection factor is 1. We've enrolled £1 million, and our share is 100%. Now I want you to look down in the middle of the endorsement, class 3. I've decided to split my endorsement into 2. So I'm going to have one endorsement that's class 3 100% and another endorsement that's class 4 100%. To keep it simple. You can do a blend price, some people do, but typically we split up our endorsement. So I'll just go over the first one. Class 3, we take that expected price of $17.75 and we multiply it by its weight, which is 100, to get the calculated expected price of $17.75. So that's our expected price. Then we need to decide what coverage level we want. And I want you to look at the difference between the 80%, which is the lowest coverage level you can enroll in, and the 95%, which is the highest. So we take that $17.75, we multiply it by that 80% coverage level, and that will get us that $14.20. Okay, but since we pay our bills here in New Hampshire, we take out that premium to get the real price guarantee that we're going to have that's going to start paying. So $14.20 minus 5 cents is going to be $14.15. So after that, if the milk price falls below $14.15, we'll get paid the difference. So for many, that floor would not be high enough. So typically I see that 95%, which would be that $16.86. Again, take out that premium, take out that 45 cents, and that gives you a floor of $16.41 per hundredweight. If you look on the far right, you'll see that there is a difference in premium, but you're actually capturing a lot different value. And if you look, you see that total premium and that producer premium, you'll see the difference between the subsidy and if you're unsubsidized. So look at that total premium, that's what you'd be paying if you weren't subsidized, and the producer premium is what you owe out of pocket. One more thing I want to show you on this class pricing example, the expected production per cow. It shows 5,800. Don't focus too hard on that. The expected production per cow is not based off of your own cow's production. It's based off that pooled number that I mentioned earlier in the webinar. Again, it's used to get us that subsidy. So it's the same for the class 4. I'm not going to go over that again, but I will take us to a component pricing example for those that are interested in that. Again, we're different county, but doesn't matter, same price. We are actually in Q4 of 2021 though, and we enrolled on April 13th. Still 1 million pounds of milk enrolled, still 1 protection factor. We decided to go with the 95% coverage level. So I would take my declared test pounds, which happen to be 4, 3, 2, and 5, 7, and I would take that expected value for that day of the protein, the butter, fat, and the other solids, and I'd multiply it across to get me that calculated expected value per hundredweight of $20.23. Notice, unlike the class pricing option, we can't split up the butter, fat, and the protein in endorsements. So you'll have to just discuss with your agent, the advantages and disadvantages of this option, but everything is blended together. So we take that $20.23, we multiply by that 95%, and that gets us that $19.22 guarantee. Again, we're going to subtract out that premium per hundredweight to get us that $18.81, which is our price floor. And that is how the component pricing option works. Notice that the expected production per cow is different. Again, we're in a different quarter, so that changes. But I did put below the same quarter where we'd have the same expected production per cow as the class pricing option. So no changes, no difference there. Here we have an indemnity example from last quarter. So our expected value for quarter 1 2021 was $19.69 using my component values of 4, 3, 2, and 8, 9. And then we take that 95% coverage level to get that $18.71. 3 months go by, the averages are taken, and we come to the actual price release of quarter 1 2021. We do the exact same thing. We multiply that actual value by the components to get that $18.39. Again, 95% of that would be $17.47. So on the right here, you would take that $18.71 and you'd subtract out that $17.47 to get you a $1.24 difference. We multiply that difference by the number of hundredweights we've enrolled in to get us that $12,375.56. Now again, we're in New Hampshire, so we pay our bills. So we're going to take out that premium cost from the indemnity to get the net indemnity of $8,375.55. So that's how the program works. That's how it played out last quarter. Okay, so here's that yield adjustment factor that I'm going to go over briefly. Again, this is what gets you the subsidy. This is what makes it an insurance program. This takes from our pooled region. So it would take the pool's actual production per cow and divide it by the expected production per cow for that day to get us a yield adjustment factor. And what you need to know about this yield adjustment factor is that it moves the indemnity one of two ways. Yield adjustment factors below 1 will increase indemnities, and yield adjustment factors above 1 will decrease indemnities. Again, this part needed to be incorporated with the program in order to make it insurance, and so it's the same for everybody. Okay, so what's covered? So this policy provides the difference between the revenue guarantee and the actual milk revenue times the actual share and protection factor of our Class 3 and Class 4 futures prices, and it's caused by natural occurrences in the market in yields of the pooled production region. What's not covered? Class 1 milk, Class 2 milk, dumped milk, loss of cattle, and destruction of dairy cattle, or any other kind of loss. It's strictly that Class 3 and Class 4 futures, and it's that revenue guarantee and actual milk revenue difference is what's covered on this program. And in sum, so the dairy revenue program creates a floor on the milk price without sacrificing any upward movement like you would in a put. So you're protecting a downward movement in the milk market. It's really important that you know that cost of production. I know it's a scary number if you don't already know it, but that will allow you to set a target milk price when electing coverage on your policy. It will help you determine, instead of calling up your agent, asking them every day, you know, is this a good price? Is this a good price? It's different for everyone, right? So knowing your own cost of production will kind of enable you to target that milk price, narrow down all the options available to you, and hopefully get you set up with the right risk management plan using DRP. Now with premium support, it makes this program also highly affordable and allows you to set that milk price. So the next steps, it's really important that you develop a relationship with an agent that understands your business. Again, you know, one thing that may work for your neighbor won't work for you. I know it won't. So make sure you get with an agent and just discuss the program. Make sure you fully understand it. Make sure all of your questions are answered before you enroll in DRP. And secondly, this one is very important. It's just a best practice. establish an application before you enroll in DRP. Since we have that time limit between 5:30 and 10 the next day, it's important that we have all of our information that we need before locking in the price. So you don't want to be chasing down social security numbers at 8 o'clock in the morning when you need to get all of your, not only enroll in the endorsement, but also pass in the application as well. So it's just best practice again, fill out that application, send it in beforehand. No premium attaches until that quarterly covered endorsement is filled out anyway. So finally, again, set that target price, look at that cost of production, and hopefully we can get you set up for any market downturns. So I may not have mentioned before, we're going to save our questions for the end, but if you have any questions currently or you have them after the webinar, this is my contact info, and you are welcome to reach out anytime. And that sounds like we're on to Tristan now. So thank you for your time, and I'm going to pass it along to Tristan Peterson.
Well, didn't mean to cut you off there, Devin, but yeah, so thank you for the opportunity to talk with you guys as producers up there in New Hampshire. Really looking forward to the conversation and kind of just give you some market insights or what we're seeing in the market. So Kyle, can you confirm that my screen is showing?
Yep, we can see your screen perfectly.
Perfect, thank you. So what I'm going to use today to kind of walk through markets is a tool that's been developed for Farm Credit East and crop growers. So this tool is proprietary, so everything you see here, if you want to be able to go into the tool and work through the tool, look at some of these numbers, reach out to Devin and she can get you signed up there. Get you in the tool to help make this decision a little easier. We know how complex milk pricing can be and all the decisions that you guys have to deal with every day. So we wanted to create a tool to really make this easier for you as a producer to go in, look at some of the historical data, look at some of the futures data, and make that best informed decision for your operation. So the key to that decision, as Devin said there, is really understanding and knowing our cost of production and having a good grasp on it. If we can get that cost of production number figured out, that really gives us a target now. It gives us a target number that we can go out and actively try to insure and protect against. So with knowing that target number, now we have to make the decision. When do we endorse? How much do we endorse? And really, what do we think the markets are going to do? You know, a year ago, I think we all had a pretty good grasp on a little over a year ago on what markets were doing and where things were headed until we saw a pandemic hit and really influenced markets in a way that was not positive for a lot of producers. Producers that had the foresight, they were looking at cost of productions, locking in those numbers above cost of productions, sustained 2020 fairly profitable. And really, as they come into 2021, have a bright outlook on their operations. So what do we see coming into 2021? So what we're going to look at is just in this tool, in the market dynamics tab under the price trends. So in a little bit, Ethan's going to kind of go over some more of the tool here. I'm just going to focus on the market dynamics and really what we're seeing in the market and how we can use that information to help us make that informed decision. So as we look at really what we're seeing here is everything on the left is historical milk prices. So we see class 3 is in our red, class 4 is in our green color there. So as we look at these prices, we can see those historical prices through 2016 through 2020 coming into Q1 of 2021 here. The idea of the program and DRP as a whole is to really create that price floor without giving up any upside potential. So if we can go in and establish some sort of floor, we tend to take the volatility out of these markets. So we see these highs and lows, and given the opportunity, we can remove the volatility out of that and almost create a level floor here. Again, not sacrificing any of the upside, so that $19.51 or that $20.25, but we're preventing from these downs, this $13.87, so on and so forth. So now that we've got a little grasp of what's happened in the market over the last 5 years, what can we expect to happen for the up and coming quarter? So on the right here, we see the expected for, and these are our quarters here, and we can change year. Anything in blue we can change here. So I'm just going to focus on Q3 of 2021 for the time being. So Q3 of 2021, if we reduce this a little bit, we can see we were holding a fairly steady milk price coming into COVID. COVID happened, milk price fell. And from there, this is where the opportunity lies. From there, we've seen a steady increase in those prices. So right now, as we look at the current price, we're looking at a $19.63 class 3 price. So as we look at that 1963 listed here, I always like to take the 95% to know what our insurance floor would be. So if we take that 1963 times our 0.95 or our 95% coverage, we could set a floor on our class 3 milk price for July through September of $18.64. So if we compare that 1864 over what's happened, there was 1 year over the last 5 years, and this is just opinion based, but I think class 3 got artificially loaded and increased through 2020 because of the food box programs, other government assistance programs that we needed at the time that really helped us with our milk markets and helped keep that propped up a little bit for us. So knowing that, we've got an opportunity today to lock in a price that's 80%, essentially an 80% higher than the last 5 years. So we can now use these numbers to start to compare. If our cost of production is this, then we can tie in what the historical average has been and the opportunity that lies in front of us. We're seeing prices today that are not quite as good as that 2013, 2014 prices, but we're getting up there. We're $1.50 short, somewhere around there. So as we see the opportunities in the market, this really, in my opinion, especially with the producers I work with over here in New York, we see that opportunity as a positive. We see chances now to go out on farm, understanding the cost of production, and lock in some sort of profitability for these operations through that 2021 year. So just coming in, looking at the data, that's really what I wanted to focus on today. Is we see these opportunities that have just steadily increased over the past 12 months to give us that chance to really take a good hard look at the program and say, what is the opportunity? What lies in front of us? Knowing what lies in front of us, there's still a lot of unknowns in the market. I know I've been saying that myself for the past year, but I still truly believe it. We saw another release of food box extended through May, excuse me. So all these factors that are coming into place to really, to help the markets and to help the people. Those factors, there's an unknown as to when they're going to end, when they're going to stop, what's going to happen at the end of it. We still have a steady increase in milk production in the US today that's growing rapidly, and our domestic market can support most of it, but not all of it. So knowing that, hopefully we get the things open back up, we get people back into stadiums and back out eating in restaurants more and more. But without knowing with confidence what's going to happen there, I think that really puts us in a situation where we still are in an unknown market. We still are in a place that there's a lot of uncertainty moving forward. And what do we do with this uncertainty? We protect against it. So if we can protect against that, if we can grab high prices today of 1963, that's an $18.64 class 3 floor. That's a huge opportunity for you as a producer today. Ethan's going to get into a little bit more of how that 1864 ties into your actual pay price in his presentation portion, but we do see prices today that are really looking beneficial for the future of the industry, and those are the prices that we want to grab and protect against. So with that, I thank you for the time to listen to me, and I will pass it off to Ethan.
All right, thank you, Tristan. Hopefully everybody can see my screen. It looks like you should be able to.
Yep, we can see your screen, Ethan.
Great, thanks. So I just wanted to review the tool that farm credit and crop growers have created to use to do some analysis and trying to determine when the best time to buy and how it's going to affect your operation using this tool. So this tool that's been created is a quoting tool, and it has a lot of opportunities, and I'd like to show you the basics of it, just so that you can understand that you can use just some of the very basic parts of this to get a better understanding of how this program works, or you can really dive into it and drill deep into some more details and really get into it if you'd like and have a lot bigger discussions. At the end of the day, it's really about every individual operation and how their how their farm works, what their net cost of production is, and sort of analyzing the basis of their on their milk check. So, and I'll talk a little bit more about that to determine what the best way is and how to set some expectations on when to think about purchasing this coverage. So one of the things that this does to start with is just can get you a quote, and Devin can go over that with you sometime. I mean, Tristan does quotes as well. This is not, as a business consultant, I usually work with people to help them understand their net cost of production and so forth. I'm not out there quoting crop insurance for people. But to do this yourself, to get a basic understanding yourself, the quote system is pretty straightforward. You set the various, select the various items across the top here. So first select your state, the quarter that you would like to quote, the amount of milk that you would like to cover. And one of the things that we like to point out is, I think Devin said it already, but there is no limit on the amount of milk that you cover here. So some of the other programs you can cover up to 5 million pounds or something like that. This one you can cover all of it. You can cover as little or as much as you'd like of your production. So you can put all kinds of different numbers in there. And one of the tactics, one of the techniques or strategies that people use oftentimes is to kind of layer in that coverage and start, purchase a certain amount of coverage for a certain amount of milk every time the price on this DRP program gets to a certain place. And that way you can try and layer some in that's above average. Maybe you'll layer some in that's sort of at the peak and get you the best coverage, and then you can layer in some that's a little bit below the peak, but hopefully you don't get any that's below average. And that way you can maximize your coverage without getting too risky. So you could declare the amount of milk that you'd like to cover. The calendar date's going to fill automatically. I think Devin talked a little bit about the coverage amount here from 80% to 95. We usually recommend 95%. Declared butterfat test and protein versus the class weighting factor. So these are items that you want to think about your operation particularly and discuss with an agent on which would make more sense. As often as not, we lean towards the class price weighting as opposed to the declared butterfat and protein test, but that's unique for each operation. If you happen to have really high test, or maybe you're a Jersey farm or something like that, then this might make more sense and definitely deserves a good conversation with your agent. On the class weighting factor, you can choose anywhere from 50-50 to 100% of one class versus the other. It's usually recommended that you choose 100% and maybe do half of your milk at this level and half of your milk on class 4, rather than do all of your milk at 50-50. But again, that's more strategy that the agent could get into with you and help you decide where you want to list that. The protection factor, we talked a little bit about that. Usually we leave that at 1. There can be some instances where you might be a little higher on that. Okay, then down here it starts to build your quote for you and give you an idea. So this compares in the columns the quote between based on components versus class 3 and 4, and you can see here that the class 3 and 4 is just a tiny bit cheaper in this instance than the components class. And at the end of the day, your revenue floor is about the same, although you're getting 6 cents more here for a little bit less money. So maybe that makes a little more sense, but it's not just about the the pennies there, you need to speak with your agent. But one of the things that I really want to talk about, because one sort of misconception that people have lots of times is they say, geez, you know, if my net cost of production is $20 and the best revenue guarantee I can get is, you know, $18.50 or $19.50, I'm still going to lose money. That's not really helping me out that much. I get the idea that maybe it's limiting my losses, but it's not really gonna help me lock in a profit. So how do we think about that? The main thing that I want to talk about today is your basis. Thinking about the basis on your farm for your milk production. So just a little bit of review. The basis is essentially the difference between what your farm price is, what you get on your farm, versus, say, the Boston blend price for most of us here in New England. So the difference that makes up that basis is usually premiums, like a quality premium, and your component level. So if your components are higher than the blend, then you get paid a little bit more. So that's what this basis is. That's essentially the difference between what you get paid on your farm and what the Boston blend price is alone. So there's a few other things that go into that basis, but it's a good idea to know what that is. And in this case, what this is saying is you could look at the class 3 futures, and if you added $2.22, that should give you about your mailbox price. Now, I know my brother used to say it was easy to figure out based on the futures, you know, what people were projecting for price, because you could just add it back to the class 3 price, and that was about what we used to get paid. Of course, a lot of that has changed, especially last year, where class 3 and 4 kind of flip-flopped and were certainly volatile, right? It's not as easy. There's not really a great rule of thumb anymore. So it's important to think about that and analyze that and try and determine what your basis usually is. And that's usually based on your production and your farm operation. So it's a good idea to know what that is, and then you can make a more informed decision when you're looking at the DRP program. So along with that is the cost of production. You can see the cost of production that's down here on the line. This line fills in if you put it in. So you've got to enter the cost of production. It's not going to determine your cost of production for you. There's a couple of different ways to determine your cost of production. Quick and dirty way is to use the expenses that you put on your tax return and divide those expenses by the number of hundredweights that you shipped in the year, and that'll give you a quick and dirty idea of what your cost of production is. But if you want to get more specific and dive a little bit deeper, you can work with somebody else, maybe at Extension or somebody like myself. We can help walk you through that and think about all of the expenses. And the main thing to think about doing it a little bit differently, not just on your tax return, is, you know, how are you portraying it to the tax person? What kind of tax planning are you doing versus how much does it really cost you to make 100 pounds of milk on your farm? So it's important to keep those things straight, but not real difficult, but it does take some time. It takes some time to think about and gather the information. Usually it depends on your records and so forth. But that's definitely something you can determine, or I can help you determine if you'd like. So once you get that, it can give us a bunch more information and think about what our profit level would be if we were able to lock in these levels. So on these particular quotes, it's saying that it's going to give you a revenue guarantee of $19.48. And this one is saying $18.65. But what it really means is you're still going to get your premiums. If you always get your quality premium on your farm, you're still going to get paid that on top of this number. If you tend to ship, you know, 4.2 butterfat and 3.2 protein, so you always get a premium because your test is so high, you're still going to get that as well. And this is what we put in here. The expected basis is based off the historical milk checks that you've received. So if you are historically higher, you know, you historically have better tests, historically get quality, then you can sort of expect this basis is. I mean, you still got to perform. Your farm still has to do what it's always done in order to get that. But as long as you have a normal year on your farm with your milk production, then what you're really locking in is this number. In this case, 2051, and over here, 2057. So about the same, $20.50. So locking in this floor is really without your basis. And when you figure I should be able to get a normal basis on top of that, then you're really locking in a pretty good price that a lot of farms could be profitable at, not the $19 or the $18.50 that people are thinking, geez, only the farms in New York are the real good producers, or the real large farms are able to achieve that. But when you consider your basis back in, when you consider the other money that you're still going to get in your milk check, what you're really locking in is this higher price. So it starts to make a little bit more sense. Now, I'm not saying that this insurance product is giving you more money than it looks like, not at all. But if you're budgeting, if you're building a budget for your farm and trying to determine what you're going to get paid and trying to project the milk price, with this, you can at least set a floor of what that pay should be, you know, based on your operation, and should help you budget, should be able to help you budget and predict where you're going to be, maybe what you're going to need to borrow in 6 months. You can have a better discussion with your bank, or maybe you're doing it to try and budget a change on your farm. You know, if you need a new parlor or you're trying to buy some more land or whatever the case may be, gives you an idea of what that floor could be. You could start to budget and figure in costs of a change on your farm. So another thing that I just wanted to show, once you do this quote, you have your basis and so forth set up here. This is for the 1 quarter that we quoted, July to September coming up, so the next quarter that you could purchase for. If you click on this show all quarters, it can show you all the quarters that you've quoted, and it'll show you your expected revenue, the revenue guarantee, and it shows your expected basis. Now, again, this expected basis is based on historical information you can enter. If you work with Farm Credit on the Dairy Profit Analyzer or the Dairy Benchmark, we've got all of that history. We can export it as an Excel file and import it right into this tool, so it can populate there. Depending on which co-op you work with, they may be able to send you an Excel file that we could just import here. But even if you don't, we can enter it by hand. You know, as much information as you want to give us, we can put in here so that you can see what your basis has been historically and have an idea of how it might play out. And looking at this on all quarters, your basis may be different through different quarters of the year. So it may affect how you decide to purchase endorsements, how you decide to purchase insurance here, you know, based on what your test has been in the past historically. You know, if you always have a higher test the first quarter of the year, or you always have a lower test the second or third quarter of the year, when things get hot, you know, that might make a change on what your strategy is. Okay, so this part is the quoting area. If we click over here, this would show any endorsements that you have in place. So if you have that application on file with Devin, you've placed some coverage on some of your milk or all of your milk, it's going to show up here and show you exactly what you have. This particular one is showing how you might layer in some coverage. So this is showing Q4 of last year, so the last quarter of 2020. They ended up locking in 12 million pounds of milk, and this shows the indemnity that was paid to them based on the product that they bought. You can see in the current quarter that we're in, they locked in 9 million pounds. So it may be that it didn't hit the level that they wanted it to, and they didn't lock in the full amount of milk, or maybe they reduced their size and don't have as much milk to lock in. I'm not sure in this particular case. This is a sample farm or an example farm. But this shows the estimated indemnity right now. It hasn't been paid yet, or maybe it has been sent in the mail and hasn't been received, that kind of thing. So it's over, and we do know that this is the indemnity. This is the current quarter that we're in here, and it's showing that there is not, at the moment anyways, we don't expect an indemnity based on the amount of milk that they locked in. This is the next quarter, and you can see these are down. They may be waiting. They may have set some targets and are planning on locking in some more milk, but haven't done it just yet. Okay, and again, it'll show if they're really thinking that there will be an indemnity, which of course at this point is an educated guess, but it's showing you here whether they expect an indemnity or not. And like anything with risk management, seeing the zeros here on what you might get paid on this insurance product is sort of bittersweet, right? You bought some insurance and it didn't pay, but if it didn't pay, it means that the money came from the market instead. So it's good and bad. It means milk price was high, which is a good thing. Unfortunately, you did spend a little bit of money for that risk management for using this product. So this shows, again, you may want to set some alerts, and that's the next thing that I'll talk about is setting some alerts on this program. If you go to market dynamics, and then on this section, click on alerts. So this is where Tristan was talking a little bit about the market and historical prices and what they're expecting. But if you move over to the alerts tab, you can set up some alerts here that will tell you, hey, this is the price you could lock in today. So maybe, for example, on this one, the trigger price is $18 is what they're looking for, what they were looking for. This is an old one for Q4 in 2020. So if it got above $18, maybe their thought was, they would get an alert, they would get an email, or they would get a text and say, hey, you could purchase, you could lock in a price of $18 right now. Maybe they lock in £1 million, or maybe they locked in £3 million because it was at $18. And then they set some other alerts as we go along. They set some at $16.45, some at $16 even. So maybe they know that this quarter they tend to have a lower cost of production, so they're okay with locking it in at a little lower price. Or maybe they're thinking that's far enough out that if I can lock in some right here, I will. But I'd really like to lock in a little bit more at this price. So maybe they've got a goal of not locking in more than half of my milk production at 16. So they've got different alerts set up. So one of the things that I just want to kind of point out is you can get into this as deep as you want or use it as little as you want. But if you work with Devin and Tristan, they can help you set it up. And maybe you set up these alerts, you have a discussion about your strategy, what you would like to do with Devin. She helps you set up some alerts. And really all that alert means is, hey, the market did something and I need to talk to Devin. So it sends you an email, it sends you a text, to call Devin and say, hey, what's going on? I got an alert, what are we thinking? And then you can review what your strategy was. Maybe you place an endorsement, maybe you wait a little bit, whatever the case may be. But I know that, I've spoken with other clients, dairy clients that I work with that have said, man, I just don't have time to really watch the markets all the time or focus on how this works every minute of every day. I'm in the fields or I'm milking the cows. And I don't have time to really put the effort forward on that. Well, this is one way to do that. Take the time and have a discussion for an hour, or 2 hours at the most, and have that discussion, look at your net cost of production, really think that through sometime in February and set some of those alerts. And then know when you get the alert, that's when you need to call Devin, and then you have a 10 or 15 minute discussion when that happens, as opposed to taking 2 hours a day to try and figure it out. So this is a really handy section that a lot of our clients appreciate on this tool. Okay, there are some calendar items that show you when the markets are closed, when the period closes to purchase for the next quarter or certain quarters. We've got some price reports here if you really like getting into all the different prices and trying to determine what's going to affect the market going forward. We've got some of the CME prices that show you things here that you can look at and try and determine what your strategy would be based on these items as well. So I guess really in summary, the main thing that I just want to point out is we've got this tool. If you're the kind of person who likes to be able to go in here and fiddle around with it in 100 different ways and figure out what's the best, least expensive option for you to do, you can do that. If all you really want to do is get a reminder to call and talk to Devin when something happens in the market, you can do that too, and just meet with somebody, sign your application and whatnot. So all you have to do is make a phone call from there on, and you can set the alerts at whatever level you'd like to lock in, wherever you'd like to be. So I think that's really all that I had to talk about. One other thing, just quick, I'm sorry. One thing I wanted to talk about when we're talking about the basis, again, remember that's sort of the difference in price, something that's unique to your farm because of quality premiums that you're getting, or because your test is higher, you're going to be able to get a higher price than the straight market or straight Boston blend price. You're getting a premium on your milk. The one wild card on that can be your PPD. So PPD in the Northeast here in New England is usually to our benefit. But as we all know, with last year being a little bit of a crazy year, if the PPD is a high negative, it can affect your basis drastically and make your basis smaller or higher, depending on which way that goes. So that's one wild card that you do need to think about a little bit on how your basis works. But again, your basis is just sort of the extra money that your farm gets for the things that it does in general. And usually with dairy and so forth, that's a positive. You may hear people talk about corn basis and things. That is a little bit of a different ball game, especially in New England here. But as far as dairy and so forth goes, the basis is really the difference in your milk check, the difference in your milk price on your farm, or your mailbox price, some people say, right, or your farm gate price, compared to, say, that Boston blend price. So again, take whatever tech you like using this tool. If you want to really get into it and play with every little window on it, or if you just want some help getting it set up so that it's going to send you some alerts and you can kind of set some stuff on autopilot, whichever way you'd like to use it, it's a tool that we tried to design so everybody could use it, whether you wanted to really dive deep or just use it on the surface. But any questions about the things that I showed, or any other questions about what I can do with clients and so forth, and how what I do relates to this? Feel free to ask or send it in on the chat.
Thanks, Ethan, for that. I see a couple of questions on the chat, maybe not pertaining to your presentation specifically, but we have a few here. Before I get into those, is there anyone on the call who would like to call in and ask a question before we get started with the chat questions? Okay, well, we're going to move to the chat questions then. Okay, the first one I have, I guess I'd send this one to Tristan. Is there a pricing option that works better than the other?
So that's a fun question for me, because this gets a little into the strategy and approach and how we tackle DRP. So when we look at the pricing options, we've got the two options. Class is one of them and components is the other. Typically in the Northeast, in our marketing order, we get paid on components. So a lot of producers tend to see more value on the component side of an endorsement than on the class side of the endorsement. But I always challenge and I always push back, and I think Ethan's portion of the presentation going through basis there and such really was kind of a nice example of why we look at this with the approach we do. So you can really break it down. There's two main reasons to kind of endorse the milk. So the first is being premium sensitive, and the second is the value of the milk to cover. So with that, and producers in the Northeast getting paid on components, that's where people tend to look. But knowing that we're getting that basis back, so the component basis versus the class basis, we're receiving more class basis through that, through the extra components that we're getting paid anyways. We tend to match the check a little better. So for anyone that's familiar with corn crop insurance, we really have two main unit structures, or way we can insure that crop. One is an enterprise unit, the other is an optional unit. So with looking at DRP, I tend to look at it very similarly when it comes to endorsing the milk. If we're utilizing a component endorsement, we're really using an enterprise unit. That component endorsement is an average of butterfat, protein, and other solids. So at the end of that, it's really that blend price. It's that Boston blend price that we're looking at. Well, what can happen is in that enterprise unit, essentially, the blend price could change. You can have drastic impacts on your check, such as what happened in 2020, where butterfat went down and protein went up, and that might not pull us into an indemnity. So because the blend price didn't really change that much, there wasn't no indemnity there to pay on. So we be cautious of that, and then we look at the class components, or the class endorsements, excuse me. So when we look at those class endorsements, we can really separate things out and make the best plan that we have available to us by utilizing, the match of what does your milk check show, what percent class is 3, what percent class is 4, so on and so forth. So with that, and we split those endorsements out, we're creating that optional unit structure. We're creating an opportunity where if class 3 goes up and class 4 drops, we're going to get paid on that class 4 endorsement, where we might not get paid on that 3, or we won't get paid on that 3 because the price went up. So the strategy behind, where do we endorse, or how do we endorse this milk, really, again, it comes back to the agent and working with Devin to understand the basis portion of the class side of things, to get that good feeling of what we've got going on there and what the true price or the true value of that milk is, so we can try and protect that the best way possible. So that's kind of my answer for you, Devin, is we've got opportunities within both. We tend to utilize on our side class endorsements a little more, just because we've got more flexibility in how we insure that milk and more opportunities for an indemnity if there is a price that drops, whether it's the class 4 price, which is tied into our butterfat, or the class 3 price tied into our protein there. So really it comes down to you as a producer, your comfortability, but we will help you out with that, and we'll help you make the best informed decision there. So thanks, Devin.
Thank you, Tristan. We have one more question here, and I think I can answer this one. So the question is, when is the premium due on dairy revenue protection? Good question. It's actually due 25 days after the quote has been determined. So premium is payable at the end of the quarterly insurance period. Fairly straightforward answer for that one. So I don't see any more questions in the chat. With that, I guess we can end this webinar. Thank you again, everyone, for attending. Thank you for our panelists for also presenting for us, and hope you have a great rest of your week.